This is a really exciting episode of Funding Awesome. I'm joined by my head of AI research, Arif, and my good friend Larry, who's been investing in tech stocks professionally since the dot-com bubble. And in this episode, we're going to cover the earnings calls of many of my top stocks to get rich without getting lucky, including Microsoft, Google, and Amazon. We'll also dive into Tesla, Meta Platforms, and a few smaller AI stocks that should be on every investor's radar after some action-packed earnings calls. We've got a ton to talk about, and your time is valuable. So let's get right into it. Let's roll right into the stocks.
All right. The first one is Microsoft. So just to confuse everyone, Microsoft's earnings that have just come out the end of March is actually their Q3 earnings based on how they do their financial reporting. So the raw numbers, Microsoft's revenue, 61.9 billion, which was an increase of 17%, a year over year increase. Diluted earnings per share, we were looking at $2.94, an increase of 20%. So in terms of revenue versus expectations, they beat on revenues, their earnings, they beat as well. Microsoft had a really solid quarter and no surprises. The stock reaction post earnings, the stock was up 5%. And you can guess what the main topic was on this earnings call in terms of where the growth was coming from. It was all about Azure growth, and AI was mentioned a lot in this earnings call.
I think this sort of puts to bed the argument that big companies can't get bigger. Revenue increasing 17% year over year for a $3 trillion company. Operating income increasing by over 20%. Net income increasing by over 20%. Earnings per share, 20%. Microsoft is starting to look more and more like a big tech startup. These numbers are great. And as you pointed out, they're all being driven by AI. They've been talking a lot about Azure AI and supplying the infrastructure for AI growth. They've made Copilot available to a wide number of people on their Surface PCs, both for individuals as well as small businesses. And of course, they hired Mustafa and the Inflection team. Mustafa Suleyman is the co-founder of Google DeepMind. And then he went on to start up Inflection. What Microsoft is saying by doing that is, hey, we're not going to be purely reliant on OpenAI to drive our AI business. We're willing to have an internal DeepMind-like team, and we're going to do whatever is best for a diversified AI ecosystem. I think they're really firing on all cylinders. So I'm curious, Larry, what do you think about Microsoft? Is it set up for long-term success? Is it about to go up, down, left, right?
Absolutely. So Microsoft to me is a core AI holding. If we take a look at the chart, so the chart itself is it's in a longer term uptrend. So the key line that I want to look at here is the green line, which is the 200-day moving average. So as long as we're trading over that rising 200-day moving average, which Microsoft is, and it's in a long-term uptrend, which is very constructive. In the shorter term, it has been a little bit weaker as the market has pulled back. So the other key line to look at here is the red line, which is the 50-day moving average. So the 50-day moving average for me is basically the short term. Do we want to put the pedal to the metal on the buys, or do we want to go maybe a little bit smaller, maybe nibble in? So right now, beneath that 50-day, the chart, it's a little bit weaker. I do think It's a buy right here, maybe a smaller buy. But then if it starts to clear 415 to 420, I think that's the green light for new highs, which I do expect that we're going to see.
And Arif, what stands out to you from the research side? Is it more of the AI infrastructure with Azure? Is it hiring Inflection? What stands out to you as the big next catalyst that could drive the next leg of growth in Microsoft stock?
It's a really interesting question because I remember last time when we covered these stocks, we talked about Microsoft being ahead in terms of OpenAI, having that as an accelerator. They were putting products out there, their Copilot and other things before the others were. And what I remember saying last time was I'm looking for revenue increase based on AI specifically. What they've started to break out now is how much of their Azure revenue is coming from AI. They actually talked about that in the release this time. So they said they had 31% increase in cloud services, and 7 percentage points of that 31 was from AI. So they're starting to be quite specific now around it as well. I think that's the main catalyst. And it's really good to see that acceleration. Like you said, the numbers are so big. The rate at which it's increasing, the growth is increasing quarter by quarter. I think this was the fourth consecutive quarter I counted of Azure revenue increasing. And I think what you just mentioned about them hiring Mustafa Suleiman, that's only going to allow them to have even greater capability. So I'm expecting them to continue to grow and improve their AI story. And because I think they're ahead of the others, I think they'll start to see the revenues actually coming in, the top line actually changing first before some of the other companies.
That's such a great point. 7% of that 31% growth, so roughly a quarter, was due to AI, which means that 3/4 of it was actually not due to AI. If people are thinking that AI is just a fad or a bubble, Azure's growth was 75% from non-AI workloads. So it's just becoming a more prolific cloud service in general. Even if you take AI out of the picture, they still have a lot of growth engines in their portfolio. And I'll show this on the screen. There's a heat map of all of their different business units and how they've been growing quarter over quarter and year over year. And this is actually one of their best quarters of growth across the board. Azure growth, Dynamics products growth, Office 365 growth. This is one of the only quarters where they didn't see any business units really decline. Most of their major business units are seeing faster growth this quarter than this time last year. So I think that's really important to call out as well. Microsoft isn't just a great AI play, it's a great diversified technology play. Speaking of diversified technology plays, what's the next company, Arif?
It's Tesla, the one that always divides opinions. The world of Tesla is so erratic and up and down. So Tesla reported a 9% drop in their revenue in the first quarter, and that was the steepest year-over-year decline since 2012. Net income also dropped 50%, and it was down to 1.13 billion or 34 cents a share from 2.5 billion or 73 cents a share a year ago. I want to mention deliveries as well. Now, the deliveries number came out a few weeks before earnings, and it was the first decline in 4 years, year-over-year comparison. Last time that happened was because of the pandemic. But then on the earnings call, Elon did talk about that they will be doing this lower cost model. And in true Elon style, he put a date out there. So he had said, previously, second half of 2025 is what he had said previously about this low cost EV. Now he's saying early 2025, if not this year. Now, Elon puts a lot of dates out there, but yeah, for what it's worth, investors heard this and they did buy up the stock. So the stock actually ended up after the earnings call.
Let's take a step back here. So first of all, a year-over-year decline in deliveries and in revenue. All four of their models, the Model 3 and the Model Y, as well as the higher end of Model S and the X, have dropped in price drastically over the last year, 6 quarters or so. At the same time, they're producing less cars, and at the same time, they're not selling every car they produce. So I do think that Tesla is facing a lot of headwinds, and as a result, we're seeing revenues drop, we're seeing profitability drop. So that definitely should be making Tesla investors nervous at this point. Larry, what are you seeing on the Tesla chart?
So Tesla is an interesting chart, and we'll look at a couple time frames. So I will say this. I'm really just focused on the charts, not so much on the company. My aspect here is the technical part. So
Sure.
The chart itself is not the best chart by far, but it's also gotten a lot better. So if we look at the monthly chart, so Tesla right now, 181 and change. It's basically the same price that it was at the end of 2020. So that could be considered a negative if someone's had it for that entire time frame. But if somebody's looking at the stock right now, they could say, well, the earnings today are higher than they were 3.5 years ago. So the fact that it's performed basically so poorly for 3.5 years could actually be considered, from a contrarian standpoint, a positive. The weekly chart, it does have a lot of work to do. So there's a positive and there's a negative to this as well. So it recently came down, looks like about 140 and change. We can see that going back a few years now, there's a lot of investors that have paid well over $200 a share for Tesla, going up to 400 at the end of 2021. So what this tends to do, it creates what's called overhead supply. And what that means is that if I'm an investor and I paid $250 for Tesla a year ago, a year and a half ago, and I've been watching it go up and down. As the price starts to recover, what happens is you'll often run into buyers that have bought the stock at a higher price. Maybe they've been holding it for a year and a half, 2 years, and sometimes they tend to get frustrated and they say, as soon as I get even, I'm going to get out. So what happens is, as you run into all of these buyers from higher prices, it does create a lot more work for the stock to move through that, because as it moves higher, there's continually sellers over the top. It is under the 200-day moving average. So that's my key red light, green light. So underneath the 200-day, it is a weaker chart, but it did start to recover over the 50-day. It does have some good price support on the chart between 160 to 180. We can see it's got a nice price base. So this is something that I would say, if I was looking at a new position in Tesla, I would consider a smaller buy. And if the stock starts to prove itself, work higher, maybe the institutions start to come back in, then I might look to increase my position on the way up.
So let me just show you that I think the trend in the stock actually does accurately reflect the trend in their financials, right? So over the last quarter, they just reported a revenue of $21.3 billion with gross profits of $3.7 billion and operating income of $1.2 billion, roughly. 2 years ago, back in the end of quarter one of 2022, they reported almost $19 billion of profit, right? So even though it increased over those 2 years, it's really only up 15% or so from 2 years ago. At the same time, their gross profits are actually down.
Right.
They reported $5.5 billion in gross profits 2 years ago. They reported $3.7 billion this past quarter. And the same with operating income, $3.6 billion this time 2 years ago, $1.2 billion over the past quarter. So they cut their operating income by 2/3 over the last 2 years. So I do think that the reason it's trading under its 200-day moving average is rooted in real things happening at the company. Production, price cuts, FSD roadblocks. So everything we just talked about, right? Arif, what about you? What are you thinking when it comes to Tesla? What big items are top of mind for you?
We can't discount the Elon Musk factor. And I know that sounds like a silly thing to say, really, or it's hard to quantify. And I think what's really fascinating is that if you take a step back and you look at the numbers that Tesla are still churning out in terms of cars and where they came from just a few years ago, it's still mind-blowing the scale they're at. And the bull case, if you like, would be like, well, they're in between two cycles in terms of the cars coming out. They will have this lower cost vehicle coming. If they do, that will really help them in terms of being competitive in the market. They also, Elon has got an event coming up, August the 8th. There is some kind of robotaxi event. Take that with a pinch of salt. We've seen him do an AI event where the very first Tesla bot was a guy in a suit. So I don't know what we'll get at this robotaxi event. But there is still a chance that if these kind of key bets that Elon's placed, if they're able to pull those off, Tesla could do really well. Part of me feels like with all of this fear and uncertainty baked into the stock price, it felt to me at the start of the year, I felt 2024 would be a good year to maybe accumulate on Tesla over a period of time. But yeah, I haven't answered your question at all.
I think when I think about Tesla today, I really think of it as a portfolio of moonshots, right? Yeah. I would never bet against Elon Musk, right. But what Elon Musk is an expert at is making moonshots a reality. And right now he's got a lot of irons in the Tesla fire, if you will, but none of them have really materialized as, hey, the cars can drive themselves. The robot is autonomous. Dojo is stood up and people are paying us for the service. And I do think that the market's opinion currently reflects that with the price chart. Speaking of moonshots, holy moly, let's talk about Meta.
Yeah, I'll break this down for you because it was probably the most interesting one in terms of the numbers and then what the stock reaction was after it. They beat on earnings, so $4.71 per share versus $4.32 per share was expected. Revenue for the quarter was $36.46 billion. which was above what the street was looking for, which was 36.16 billion. Revenue increased 27% year over year, which is the fastest rate of expansion for any quarter since 2021. The Q2 forecast was very good as well. Everything was looking really strong for Meta. But what's so interesting was that even post the earnings numbers hitting as well, the stock market reaction was up. But then it crashed. And I think at one point it was down 20%. And it's really interesting to get into this, Alex. And I think it's something you've spoken about before as well. So the reason Meta's stock were impacted so negatively was the opening comments from Mark Zuckerberg. All he spoke about really was the metaverse, augmented reality, mixed reality, those kind of, if I could use the word, moonshots that you were just mentioning for Tesla. Meta's moonshots were the real focus. And the reason investors get nervous is those are the parts of the business that are making no money, that are real loss leaders. Whereas investors, last year we spoke about the year of efficiency for Meta. They're really focused on their core family of applications where they have their huge revenues from advertising, and they focused less on the metaverse. But in this earnings call in particular, the comments from Mark Zuckerberg, it really felt like we were back to maybe where we were a couple of years ago, with investors really nervous around how much money is being plowed into this moonshot, and will it ever bring any meaningful revenue back into the business?
When I actually heard that earnings call, I wasn't worried one bit. I think the market really has this one backwards. The reason they're able to spend all this money on long-term bets now is because they got so efficient last year. Now we're getting to see the fruits of all that labor. He's investing in infrastructure like H100s, B200s from NVIDIA so that he can provide AI tools and experiences, whether that's Llama 3 being one of the best models out there and being open source to the community, whether that's smaller models that go into devices like the Ray-Ban Meta glasses, the Meta Quest 3. They just rolled out AI search across their family of apps. So I really don't understand why the market reacted so negatively, because these aren't like metaverse level moonshots. These are things that Meta will be able to implement pretty soon. And I think Mark Zuckerberg has done a great job over the course of his career showing that his long-term bets tend to pay off big time. What do you think, Arif? Do you see this as a long-term moonshot like the metaverse? Or is this just investing in infrastructure for the next phase of Meta platforms, which includes things like AI?
I think he has to do this. Like, what else is he going to do? Is he just going to sit with this family of apps and wait till they're disrupted by someone else? Like, there has to be a bigger term play. You know, where is the puck going? Not where is it currently? So I think it absolutely makes sense. And we've talked about how maybe there's only a few people on the planet capable of really producing something like this, and they will get disrupted, as they already have been from people like TikTok. So I think they have to do this. I think that the problem is the amounts being talked about are eye-watering sometimes. So I think the CFO talked about $35 to $40 billion is the sort of capex that they're expecting to spend in 2024. And I think the reality labs is hundreds of billions of dollars over the years have been burnt in that area, and the revenues coming in are really small. They're in the millions of dollars. So that's what just makes people nervous, this high level of expenditure. My take on it is they have no other choice if they want to be a company that's around for the next decade. They have to do something like this.
My point of view, at least, is this is very different from Reality Labs because AI can affect their core business. Higher conversion rates, higher view times, higher engagement rates, more time spent on the platform. So I think this is going to pay off much sooner than the big bets on the metaverse. And we should be seeing it across all of the metrics that we care about across the entire family of apps, whether that means AI searches going up and people spending more time searching on Facebook and Instagram, or whether that means helping creators create new kinds of content by leveraging AI, which means more content on the platform, better content on the platform, which of course increases engagement, which of course increases advertising spend, and it's a virtuous cycle, right? Some of these eye-watering numbers, I think, are just because, if I remember right, Meta Platforms' family of apps serves something like 3.2 billion people a day, right, altogether. That's 40% of the entire planet. It's a project that affects 3.2 billion people, which means we need to drive the cost of training down, but even more than that, the cost of inference down, which just takes a lot of infrastructure. I think their AI infrastructure bets today are going to turn into material gains over the next few years. And then, of course, all of that infrastructure can also help power the very long-term vision, augmented virtual reality, and then ultimately the metaverse. So I think if you think about it that way too, as this AI infrastructure play of killing a few birds with one stone, near term helping with the core business, midterm positioning Meta platforms to be a leader in AI, and long term still being applicable to the metaverse. Now I think what you're just looking for is the best entry price and the best like long term buying opportunities. Don't listen to me, Larry. What is the chart saying?
So quickly, I agree with you, Alex. And Meta by far is a core long-term AI holding. And I think that they're absolutely going to get it right. What these companies are doing right now is they're investing in their future. They're investing the money now, and they've got such a big lead over whoever their smaller competition would be that I think that they're doing the right thing by being very proactive. They've really stepped up their CapEx budgets, and they're investing heavy right now when they need to. And I think that I agree with what you're saying. I think that you're going to see a big payoff down the line from these companies. So if we look at the chart, same thing, long-term uptrend. So if we look at the green line, 200-day moving average, price is trading above, that's rising. So that's all constructive. The stock did sell off pretty sharply after earnings, but on the chart right now, it's really in the middle of a very big range. So the $400 line, I would consider that really the hard floor for Meta. There was obviously a big breakout from there, and I could envision Meta drifting up maybe to that 480 level, especially if the market continues to recover higher. And then once it starts to get to 480 to 500, it could run into some selling pressure. But overall, the long-term uptrend is intact. And really, at 400, if for whatever reason, if the market started to pull back further, which I don't think it's going to based on the charts, but even if it did, there's a lot of key support for Meta at 400. And if I was looking to start a position in Meta, I would go smaller. And then if it starts to work higher, if my thesis is right and the market confirms that with institutions coming in and pushing the stock up, then I can always add to it on the way up. But a longer term uptrend is intact. Shorter term, a little volatility. But overall, I think the chart's going to be fine.
Meta Platforms is doing this because they want to make sure that the next generation of social media includes all of this new technology, whether it's spatial computing or whether it's AI.
Right.
Then there are companies like Google who are trying to do it so that they can be their own disruptor versus having an external disruptor like Perplexity, for example. So Google, right after they release their Gemini 1.5 Pro model, we have Meta releasing Llama 3. And it turns out Llama 3, A, open source, B, very cheap, and C, is near state of the art. Google has a big problem. They're not going to lose search to any one company. Search is moving away from 10 blue links to answers fed directly to you, skipping all of the ads and the middle steps along the way. So, Arif, with all that, why don't you roll us right into Google?
Yeah, really interesting one, this as well. So Google, they had a nice earnings beat. Their revenues increased 15% from a year over year, which was their fastest rate of growth since 2022. So revenues came in at 80.54 billion versus expectations, which was 78.59 billion. Earnings per share was up as well, 1.89 versus the street was expecting of $1.51. So there was a nice stock reaction after these earnings. One of the main reasons why the company announced their first ever dividend. So Google announced their first dividend and also a $70 billion share buyback. So yeah, those two things will help with the stock price, but very good earnings from Google. And Alex, once again, in terms of the main things that they spoke about on the earnings call and the drivers for growth, it was once again around cloud and around AI, just as we were seeing for Microsoft as well.
One of the things I want to point out is stocks can pop for a lot of different reasons. Some reasons that a stock can pop is catering more towards shareholders, its first dividend, issuing more and more stock buybacks, rather than ramping up a new technology as a new revenue stream.
They've really improved their operating income. Their operating incomes were up 4x and now up to 900 million. So I think Google have had some like you were saying, there's different reasons stocks can move. There's different reasons companies can improve. I think Google have been less in terms of brand new innovation and more around just doing things such as job cuts, which has helped their overall profitability. Your point is a key one. They're almost distracting people by saying, hey, look, doing well, like, you know, those shareholders are being rewarded. But the elephant in the room is the fact that actually their search business is being disrupted.
So this is an example of what I think is the innovator's dilemma. Do we build technology that eats into our own search market share by building answer engines, by developing new ways of answering questions that have less advertising in them? Or how else can we prop up our stock price? In this case, dividends and buybacks. Short and medium term, I'm pretty happy to be a Google shareholder. But long term, I really want to see that AI innovation come out of Google to make sure that they're doing everything they can to retain their lead or transfer that lead to something new, whether that's AI agents, whether that's new forms of physical devices, whether that's Android or something else. Typically, I'm not looking for stocks that go up because of dividends and buybacks. I try to look for stocks that go up because of long-term disruptive innovation that comes with large defensible moats that make them winners over the long term, because dividends and buybacks really only get you so far, and with certain kinds of institutions. So, Larry, why don't you tell us what the chart is showing you?
So Alphabet's a great chart. It's one of the best charts really in the NASDAQ 100 by far. So if we look at the chart itself, it's over all the moving averages. 200-day moving average is rising. The 50-day moving average is rising. It's got a very nice, consistent weekly uptrend. We can see it's been stair-stepping higher. That's exactly what we'd like to see on a chart. It has a tremendous amount of weekly support between 140 to 150. And from a technical perspective, it really is one of the best charts in the market right now.
So what's the overall, what should people be doing with Google stock? Buying in slow, holding it if they got it?
Google to me is a full position buy right now. So if I was looking at a position in Google just based on the strength of the chart, because keep in mind, I'm not a short-term trader, so I look at the longer-term trend. And when I see such a strong trend with a lot of price support underneath it, it's a chart that I would be comfortable with a full position in.
Not to mention now you're going to get a dividend for every share you hold.
And I do agree with you about the concerns with the financial engineering versus actual product innovation. And that's a concern that I've had, but the market really bought into the stock because we can see it tested that 200-day, and you can see this is where the institutions came in. And that's why I use this 200-day moving average so extensively, because it did exactly what you'd want to see. That was about 6 weeks before earnings. And the stock's just been acting really well. It's a very good chart right where it sits.
Yeah, I think Google is one of those really safe bets that it's such a diversified portfolio of technology between Google Cloud, Gemini, obviously their core search services, their advertising services with AdSense, Android. Google has so many irons in the fire that are constantly paying out. And now being able to issue massive buybacks and dividends, it's still a great long-term tech stock. And speaking of big markets, let's talk about the next company on our list, Amazon. So Amazon Web Services powers roughly 1/3 of the internet today. They're the largest e-commerce platform in the world. They employ more robots than probably every other robotics company combined. There's a lot of markets where Amazon is number one. So, Arif, why don't you tell us about Amazon's latest earnings call?
So their revenues came in at 143.3 billion versus 142.5 billion, which was expected. So a small beat there. Earnings per share as well was better than expected, 98 cents versus 83 cents. Good quarter for Amazon. And as you mentioned, their big area is Amazon Web Services. That brought in 25 billion versus in revenue versus 24.5 billion that was expected. And advertising as well came in, which is another huge area for them. $11.8 billion of advertising. We always comment on how big Amazon's advertising revenue is. 11.8 versus 11.7. So really strong, solid beats across the board. And the guidance as well was pretty much in line with what expectations were. So what I'd say with AWS is over the years, Amazon have put so much money into that business. It feels like now that's coming to fruition, and AWS accounts for 62% of their total operating profits. So it's a huge chunk of Amazon. But it feels like their cloud business is continuing to grow. They still have the largest share. Obviously, there's a threat from Microsoft, but at the same time, their core business around their stores and their Prime delivery and things like that, where they've also invested so much, those are also becoming more healthy in terms of profitability. They also have been on a bit of a cost-cutting spree as well, and that's just helping their profitabilities. And so overall, Amazon are sort of on the right track in terms of becoming more profitable.
One thing that I think is really underrated is the fact that they have much higher conversion rates than, for example, Google Shopping, because when you're on Amazon.com shopping, you already have high purchase intent. So the reason Amazon advertising makes so much money and so quickly is because they're advertising to people who are actively looking for an advertisement to solve their problem. One of the things I really respect about Amazon is not just that they have all these different irons in the fire, Amazon Web Services, advertising, their core e-commerce business, and so on, but how all of those pieces fit together into one walled garden ecosystem to bring you a great experience that quickly finds you what you're looking for, gets you into checkout with the push of literally one button, gets that item to your door, and all of those things behind the scenes at every step are leveraging AI, are leveraging their cloud services, are leveraging their advertising business. So I think Amazon is low-key one of my favorite companies, not just because you have access to a wide portfolio of technologies, but because of how those technologies fit together. Amazon Web Services just hit $100 billion in annual revenue, right? That's insane. And that acceleration is largely due to all of the generative AI and the new AI models that they're supporting on AWS. At the same time, their advertising revenue, not only is it big, but it grew 24% in the first quarter, right? So it's actually one of their fastest growing business units. Each one of those business units feeds into the other. As their AI gets better, their advertising will convert more. As their advertising converts more, they'll see more revenue in their e-commerce business. As they see more revenue in their e-commerce business, they'll ramp up the amount of robots they need in the warehouse to fulfill orders. So there's a lot of network effects, I think, not just in the Amazon ecosystem between customers and vendors, but also between the different parts of the ecosystem that their business units make up. If it's early days for any one of those business units, it's early days for the company as a whole as a result. So now the question is, Larry, is it still early days on the chart? What does the chart tell you?
So, Alex, it seems like we saved the two best charts for last. Amazon, very strong chart. As of now, it's trading over all the moving averages, and it's got a really nice series of uptrends, which is what I really like to see. So what I mean by that is if we look on the chart, it's trading at 186 right now. So between 170 and 180, you can see there's a very nice congestion zone in here. This is the opposite of what I talked about on the Tesla chart. So instead of having overhead supply where there's maybe buyers that paid higher prices that might look to sell, what we've got here is we've got a nice support zone of quite a lot of buying between 170 to 180. So what that does is it provides almost a cushion. Whereas if the stock starts to pull back, it's got some price support below, and then we can see 150 to 160. So overall, Amazon it's a great chart on every time frame. If we dial out to the weekly uptrend, we can see it's trending higher weekly. These moving averages are also rising. So from a technical perspective, of the five that we've looked at, Amazon and Google are the two best charts right now.
That makes a lot of sense. They're two big, stable, large technology portfolio companies. Google showing a lot of financial discipline. Amazon really firing on all cylinders and having all those cylinders work together in one coherent e-commerce engine. Okay, Larry, so we've talked about some of the biggest companies in the world today. We've talked about Microsoft. We've talked about Tesla, Meta Platforms, talked about Google, and then Amazon. Some people are tired of hearing us only talk about big tech companies, big AI companies. what other charts should they be looking at right now?
So I do have other tech and AI, but they might not be the Magnificent Seven. So a few charts
Sure.
that are very high on my list, and I think that we should keep on everyone's radar screen. Dell Technologies and computer hardware. Dell is number one in AI server market share, and we can just look at the chart. Rising 200-day moving average, the green line. It's got the rising 50-day moving average, which is the red line. And something that I find very interesting is we had this recent correction in triple Q. Maybe it's almost over. Maybe we're working our way through. But you can see the red line on triple Q. This is the 50-day moving average. So triple Q lost that 50-day for a bit. It's still underneath right now. And it actually lost the 100-day. So what I do as a technician is I look for stocks that during the pullback held up better than the market. Because what that tells me is that even when institutions were selling and they took Apple below the 200-day moving average and they took Tesla below the 200-day moving average, a chart like Dell, the institutions have not been so quick to sell this stock. It really has not even tested that 50-day moving average. So Dell, it's a performance leader year to date. It's up 64%. So it's leading the market year to date. It's leading the market over the past 12 months. And it's one of my favorite charts in any sector on the screen right now.
I'm going to take another look at Dell.
Then Micron Technology is another one that Micron plays very well into AI, but they're in a different part of the chain. But here's the key thing. Once again, over that rising 50-day. So what this tells me, and Micron just had a very big breakout. We can see earnings down here. The market really reacted well to earnings. And here's the thing. When the markets pull back sharply, like we saw recently with the S&P and triple Q, most stocks will pull back. But once again, we can see with Micron, it held that rising 50-day moving average very nicely. And this is a chart that if Micron starts to clear, I would say 118, 117 to 120, if it clears that level on a technical basis, which I do expect that it will, then I expect that Micron's going to test new highs.
Wow. All right. Micron's another one we got to look into.
I got another one, Western Digital, also in the technology sector. They're in that computer hardware group, and they're in a little bit different end of the chain as well. But same thing, if we just look at the trend on this chart, this is the ideal trend. What you want to see on a chart is that gradual stair step higher, where you have a series of higher highs and higher lows. You want to see that staircase to the stars, so to speak. And that's what we see in Western Digital. If we look at the 200-day is rising, 50-day is rising, and we can see it tested the 50-day here, and it held in February. It held over in March. A little bit of a test recently. They just reported earnings, very nice uptrend. And these are our three stocks that are AI beneficiaries, but they're not the Magnificent Seven. These are stocks that might not be on everyone's radar screen, but they should be.
Dell, huge play in data center infrastructure. Micron makes high bandwidth memory for NVIDIA's systems. And then Western Digital makes non-volatile memory, so hard drives and things like that. That's a great list of stocks to augment the 5 of the Magnificent Seven that we talked about today. Right. So I think whether you're looking at the Mag 7, whether you're specifically looking for a new take on Tesla, or whether you're looking for diversified plays across the AI ecosystem, hopefully these 8 stocks that we highlighted today have something for every type of tech investor in them. So with all that, this is Ticker Symbol U. My name is Alex, and I'm joined by Arif and Larry, and we're reminding you that the best investment you can make is in you.